A conflict thousands of miles away is quietly crashing your stock portfolio. And the scary part? It's all connected through one global domino chain.
So, if you've been watching the Indian stock markets lately, you probably noticed they're under some serious pressure. After a nice period of calm, volatility is roaring back, and a lot of investors are starting to feel the heat. So what's really driving this sell-off? Well, in this explainer, we're going to connect the dots, all the way from global tensions to how it's affecting our markets right here at home. And we'll even lay out a clear framework for how you might think about navigating all this uncertainty.
Let's start with just one number, over 20. That's where the Nifty VIX is sitting. Now, you might know this as India's volatility index, but most traders just call it the fear gauge. And after a little dip, it has spiked right back up, which is a pretty clear signal that anxiety and, well, fear among investors is on the rise. So what's causing all this panic?
Here's how we're going to break it all down. First, we'll take a look at the damage across the entire market. Then we're going to trace what I'm calling the global domino effect that's causing all this chaos. We'll also put a spotlight on the IT sector because it has been hit particularly hard. And then finally, we'll explore a practical playbook for investors trying to make sense of it all. All right, so let's dive into the big picture. The markets are definitely feeling some significant pressure, and this isn't just a case of a few bad apples, you know? The sell-off is wide and it's deep. Just look at how uniform this is. We're seeing some pretty sharp falls right across the board. It doesn't matter if you're looking at the big guys in large cap, or if you're in mid cap or even small cap companies. It's the same story everywhere. This isn't some isolated problem. That negative sentiment is hitting every single corner of the market. So, what is the root cause of all this? Where is this coming from? Well, the answer actually lies way beyond our borders. The fall we're seeing in the Indian market is basically a chain reaction. It's like a series of dominoes tipping over, and it all starts with major geopolitical events. And here's exactly how that chain reaction is playing out. First, you have geopolitical tensions flaring up. That, in turn, causes crude oil prices to surge. This then weakens the Indian rupee and pushes up government bond yields. And the final domino to fall? Foreign investors, they see all this risk and they start pulling their money out. Let's dig into each one of these steps. That first domino is all about geopolitical uncertainty. And the epicenter of it right now is the Strait of Hormuz. I mean, with a near blockade by both Iran and the US, plus ongoing attacks on shipments, this absolutely crucial waterway for the world's oil supply is in turmoil. Nobody knows what's going to happen next, and if there's one thing markets hate, it's uncertainty. The direct result of that tension is a massive spike in oil prices. Brent crude has just shot up from around $73 a barrel to over $107. We're talking about a jump of more than 46%. For a major oil importer like India, a price hike that big, that fast, is a huge economic shock to the system. And this oil surge creates immediate ripple effects right here at home. The rupee has weakened past the 94 mark, the 10-year government bond yield is getting close to 7%, which basically means the market is pricing in some serious inflation risk. And you can forget about interest rate cuts. If this keeps up, we could even see rate hikes, which would slow the economy down even more. So what happens when international investors see all these warning signs? A weaker rupee, rising bond yields, inflation. Well, they sell. And this outflow of capital from foreign institutional investors, or FIIs, puts direct, heavy selling pressure on our stock markets, which just drives prices down even further. It's a vicious cycle. Now, while the entire market is feeling the heat, there's one sector in particular that's been hit way harder than the rest. Let's turn our focus to what's been happening in the IT space. Look, sectors like defense, pharma, and FMCG, that's fast-moving consumer goods, they've all seen some pretty significant declines, but the IT sector, it's experienced what you can only call a complete bloodbath. The fall here has been far more severe than anywhere else, and it's really being driven by a nasty combination of poor quarterly results and some really weak guidance for the future. All of this has effectively turned the entire IT sector into what's known as a contrabet. That's when investors are basically betting against the current negative trend, hoping for a big rebound. Now, if they're right, the returns could be massive. But if that negative trend continues, well, the losses could be just as significant. It's a classic high-risk, high-reward situation. And that brings us to the most important question of all, right? With all this volatility, all this fear and uncertainty, how should an investor, how should you even begin to approach a market like this? Okay, so let's explore a framework for navigating this kind of market. Now, I want to be really clear. This is an investment philosophy. It is not financial advice. It's just a way of thinking about risk and reward when things get turbulent. This framework really has two sides. On the loss side, it's all about discipline. A 25 to 30% drop in a stock should make you cautious, make you reevaluate everything. At a 40 to 50% loss, the rule is simple. Cut your losses and sell. But on the profit side, it's all about patience. If a stock is up 60% and its fundamentals are still strong, you let it run. That is how you find those true multi-baggers, investments that can return many, many times what you put in. Now, that was the strategy for a single stock. The strategy for a major market crash is different. If the overall market drops up to 40%, you stay invested, but you monitor everything like a hawk. If it drops between 40 and 50%, you start to systematically sell off a portion of your portfolio. And if the fall goes past 50%, you consider selling up to half of your holdings and just moving that money to cash. And this is a really, really crucial distinction. The capital you get from selling a single stock that hit its loss limit, you immediately redeploy that money into another potential opportunity. But the capital you free up by selling during a broad market crash, that is held as cash. It's a defensive move, all about preserving your funds until the storm passes. All of this, cutting your losses, managing risk, holding cash, it all boils down to one simple golden rule. And here it is. The principle is to save the principal. It's as simple as that. You can't generate future returns if your original capital gets wiped out. So protecting it has to be priority number one, just to make sure you have the resources to capitalize on opportunities when the market eventually turns. So the final question is your strategy built to save your principal?
Once you understand this chain reaction, market crashes stop feeling random. Follow for simple breakdowns that actually help you survive volatile markets.